Let's bring it back here to Australia with my next guest saying the recent market moves have seen a realignment of value in small and mid caps. So to take us through how he's playing it, Marc Whittaker joins us from Investors Mutual. Marc, it's really good to see you again in studio, no less.
How are you, Nadine?
If we talk about a realignment of value, what is it, how?
Yeah, it's a nice phrase to throw out there, but by that what I mean is what we're seeing, certainly over the last 12 months and what we saw across the course of January, particularly in smalls and micros, if you want to take it that far down the market cap index, was that the market has started to refocus back on fundamentals. So if you think about small caps, we think about any stock outside the ASX 100, really the index is often driven by, I would say, froth and bubbles, so thematics that tend to dominate investor sentiment and tends to take on a momentum of its own, whether it's the lithium stocks, whether it's biotech, whether it's medtech, whether it's the buy now, pay later. All these sectors.
You just named all of those hot areas that
all these sectors have had their moment in the sun
Yeah.
and have really driven the index at various points in time. If you look at the index over a 3 or 4 year period, if you took out these hot sectors at any one point in time, the index itself has probably been largely flat or slightly up. So it's really been driven by these hot thematic sectors. And that's really encouraged investors to really take their mind off the fundamentals in terms of long-term investing and really think about, well, let's chase the hot money. Not all investors, mind you, but a good percentage. And I think just the last 12 months has been a good reset for the market to think about, well, hang on a second, when we look to own small caps, and not just large caps, but small caps, what are the fundamentals that we're looking to own? What are the types of companies? And that are things like competitive advantage. We're looking for companies with good operating margins, the ability to price. We talk about inflation and the potential enduring inflation that's coming. We want to own companies with pricing power, and you can own companies like that in small caps. We want companies that have an ability to reprice. We have companies with good balance sheets that can generate good free cash and give that cash back to shareholders. It's not just about growth names that grow revenue and a price on a revenue multiple. It's actually owning companies that we can own for 5+ years, put in the bottom drawer and say, you know what, this small cap company is going to compound over time and give us a great return over an extended period of time instead.
Focusing on fundamentals, but you have to keep in mind the macro environment as well. So when we are in a period of potentially rising interest rates around the world, does it become more difficult to focus on those fundamentals in the small cap space, or no different than any other time?
No, I think quality is always important. And if you go through the small cap index, there's a lot of, I said froth and bubble, there's a lot of rubbish in the index as well. I'm not going to name any particular names, but there is a lot of things and stocks in the index which are uninvestable from our point of view. So it's really about focusing on qualities. It's good management teams, it's good industry structures, it's good quality franchises, and there's plenty of those in the index as well.
Name one.
I've got a few I can name. Look, as I say, inflation is topical. The question is how enduring it is, how high it can push. Supply chains are constrained. So thinking about names that are insulated from those particular pressures at the moment, I think are quite important. An interesting name is QIP, Quantum Intellectual Property Group. Probably not one that many of your listeners are familiar with, but it's basically a patent attorney. So if we look at corporate Australia, we look at multinationals offshore, they need to protect their IP, they need to register their IP, their research and development. QIP is one of the leading IP protection and enforcement companies in the country. They've got a list of blue chip corporate customers who have continued over the course of COVID, over the last 3 to 4 to 5 years, to invest in R&D and to profit from the fruit of their efforts in R&D. They need to protect that. And QIP is one of the key enablers of that protection. So they've got an ability to price, they grow their revenues at CPI or higher. They've got the ability to put price increases through. The demand side for them is not a problem. Their customers are continuing to invest, they're continuing to need IP protection. And they're a key beneficiary of the currency as well. So we look at the currency at 71 cents. QIP prices in US dollars, but its costs are all in Aussie dollars. So it's actually a currency squeezer, as we say, and benefiting from foreign exchange at the moment as well.
And not a lot of competition in the space?
No, there are multiple players, but these are one of the larger corporate players in the country. Look, it's trading on 14 times. It's on a dividend yield of 6%, fully franked. As I say, a very good cash generator, really ticks those boxes in terms of what we're looking for. A very good management team as well. We think, not a particularly exciting stock. You could argue it's boring, but we think boring is quite beautiful in this current market, and it's one of those compounders that I've spoken to you about.
Yeah. Okay. Well, and in this current market being a volatile market, so there will be pullbacks. I mean, do you have sort of a list at the ready for companies that you would be happy to buy in the case of a further pullback?
Well, I think the beauty of January was that we saw the good, the bad, and the ugly all get sold off to some degree. in our view, the good probably not sold off as much as some of the bad and the ugly stuff, but it has created opportunities. So there's always a reserve list for us. I mean, we do like buying more of what we already own, because when they fall, we're happy to own more of those particular types of stocks. We think the quality is there. We think the valuation support just gets that much stronger. But in my mind, companies like Australian Clinical Labs, ACL, companies like TPG Telecom, perhaps not quite as a small cap as some of the others we've talked to, but these types of names are very good quality companies, good enduring franchises, trading on very compelling valuations. ACL's trading on a dividend or a current PE of 8 times. It is benefiting. It is one of the largest pathology companies in the country, so it is benefiting from the tailwinds of COVID testing and so forth. That will roll off, but in the interim, we get an 8 times PE. We get a 6% dividend yield, fully franked. It's acquired a competitor in New South Wales most recently, which gives it a national footprint in the pathology industry, makes it a very credible third player to the likes of Sonic and Healius. Very good management team. Melinda McGrath, the CEO there, I think she's one of the better CEOs in the small and mid-cap space. And when we talk about management teams in small caps, they are critical, because CEOs can really drive the outcomes for small cap companies. We look at Telstra. The CEO of Telstra can move the ship a little bit, but by and large, the company's going to run itself. The industry tailwinds or headwinds will play a part. But in small caps, management teams are utmostly critical, and Melinda's a very good CEO.
Okay, so Quantum Intellectual Partners, Aussie Clinical Labs, TPG Telecom on a bit of a pullback. Are you expecting more of a pullback there at Investors Mutual?
It's going to be volatile, so I wouldn't say, obviously January was a significant drawdown for the markets. February started off a little bit better. I think by the dips, a bit of an approach at the moment. We are going the reporting season, so we're going to have some volatility around that as well. I think the headwinds are well known in terms of COVID disruptions, supply chain disruptions. The ability to put pricing through and maintain margins will be a challenge for some companies, but that's well known. So I guess the market at the moment is buying what they know. Market hates uncertainty. We had that uncertainty in January. We've had some clarity on perhaps where rates might go. Phil Lowe today making some comments there. So let's give the market a little bit of, I guess, comfort to buy the dip a little bit, but we will get volatility for sure. And opportunities will present themselves, and we'll be there to take advantage.
I had a conversation yesterday about some software names. Yes. Whisper came to mind. Nitro was another one. But in your view, is it too early to look at tech names in this volatile environment? Yeah,
look, we aren't complete dinosaurs at Investors Mutual, and we do like technology companies. Where we can find the right types of technology companies at the right price, we're very happy to buy. I talked about froth and bubble in the sector earlier, and that's certainly been a sector that's benefited from the froth and bubble in many ways. But a name I particularly like in the technologies sector at the moment is Codan. C for Charlie, ODAN, and the ticker CDA. Look, when we look to own companies that can dominate a niche, I think, and dominate it really well, are good companies to own. And Codan is a dominating player in the metal detection space globally. So it's a technology company that basically utilises radio communications, radio waves to build out technology products. Metal detection, it's the number one player there. It has the scale. A number of competitors globally, yes, particularly in North America, but they don't have the scale. They don't invest in the R&D. Codan is arms, shoulders, and heads above the competition.
That chart looks pretty ugly, though. So that's the value creeping in?
It is to a degree. Look, we owned it in the past, and we sold it some years ago at what we thought was a very good price. It did get caught up in the froth and bubble, where it ran to an $18 sort of price level. We were happy to buy it back around the $8 to $9 levels, so where it's currently trading today. Had an earnings update out just the other week, which confirmed their guidance numbers for this year, which is quite good. So it had a nice little pop on that, giving a little bit of that back in more recent times. But where you can dominate a niche like they do in metal detection, they've also got a very strong second leg in radio communications. They're moving into a tier 2, tier 1 type provider in radio communications globally. Yeah. And some of their clients include the US military now more recently. We think that's a very high quality business. Now, the revenue line can be a little bit volatile, but when we talk about quality, cash generation, the ability to dominate a market, good industry structure.
Those fundamentals.
There's not a lot to not like about it. 16 times, 3% dividend yield. It looks pretty good to us.
Marc, it's been a pleasure. We'll speak again. We'll speak again
soon. I'll shut up now.
No. Thank you so much for joining us. Always appreciate it from Investors Mutual.